On today's video, we're going to talk about the Federal Reserve rate. We're going to talk about US 10-year treasuries and what does that mean for interest rates for mortgages, and most importantly for you as a seller, what does that mean in terms of getting your home sold? Hey, I'm Mark Stillings. I'm a realtor. I've been doing this about 18 years in the San Antonio market. And today I'm going to talk about these topics so we can understand the relationship between mortgage rates and selling your home. So let's talk through some of these concepts like the Fed, US Treasuries, and interest rates and mortgage rates. The first thing we need to know is think of this way. The Federal Reserve sets the cost of wholesale credit. This is for big banks like the Chases, the Wells Fargos. They're borrowing money overnight at what they call the discount window. So think of that as like being wholesale on the cost of credit. That doesn't automatically mean the retail rate or mortgage rates that you would pay as a buyer are going to go down. They might, but they might not. And what that means for the seller is we need to monitor this because obviously as rates go down, more buyers get into the market. That's going to make it easier for us to get your home sold. So the Federal Reserve rate is usually 1.5 to 2 percentage points below what we see with mortgage interest rates. The reason they're not directly connected is because investors buy the US 10-year treasuries and they're buying with not only today's rates from the Fed in mind, but they're looking at the future in terms of what they expect with things like inflation and the strength of the economy, and they're making some bets. So let's talk about the relationship between the Federal Reserve, the US 10-year Treasury, and what that means for your mortgage rates. So when the economy is hot, investors are voting with their dollars and they're going to put it into equities. That means the cost of treasuries is going to go down, the yield's going to go up, and that means that mortgage rates will fall. However, if the economy is soft, inflation is high, and investors are scared, they're going to take their money out of equities and put it into treasuries, and that means the mortgage rates are going to increase because they're getting less of a yield. So you can think of sort of an inverse relationship. The hotter the economy, then generally mortgage rates are going to increase. The cooler the economy, mortgage rates will decrease. What does that mean for you as a seller? Well, obviously we're monitoring this. As rates decrease, that draws more buyers into the buying pool, and that's going to make it easier for us to get your house sold. We've seen in San Antonio this year that prices have fallen probably a couple, 3% on average. We're down 10% off the peak. We need more buyers in the market. There's a lot of research that shows that if mortgages get into the 5.5 to 5.75 range, that's going to unlock a pool of buyers, and we're going to see a lot more activity than we've seen in 2025. So that's why as your realtor, I'm not a mortgage lender, but I'm keeping an eye on mortgage rates because that's going to impact the number of people getting in to buy homes. It's going to influence your showings. It's going to influence how quickly we can sell your house. And at the very end of the day, whether you're going to get your top dollar or not, it's going to affect our negotiability. So where are we right now in late October, beginning of November 2025? The Federal Reserve rate is just over 4% at 4.09. Again, if you allow a spread of about 1.5 to 2 points, what we're seeing is in the retail mortgage rates, things that being about 6.25, maybe 6.3%. What I really hope for and what I'm keeping an eye on is I'd like to see one more Fed drop at the end of the year in 2025, and let's see if we can get those mortgage rates steadily with a number that starts with 5. Even if we're talking about 5.75, 5.85, 5.9, psychologically that's much more appealing than anything with a 6. And I project that when that happens, you're going to see more buyers come out of the woodwork, we're going to see activity increase, and we're going to see homes sell faster and for a top dollar. So that's just a basic overview of the relationship between the Federal Reserve and mortgage interest rates. If you want more information, you're curious about how this all ties together, or you just want someone to keep you updated on what's going on in the market, reach out to me, go ahead and DM me or email me. I'd love to talk to you about it. We'll see as a seller how that's going to impact the sale of your home. If you found this helpful to understand the connection between mortgage interest rates and the Federal Reserve and what it does in terms of selling your house, make sure to hit like and subscribe, turn on the notification bell for future videos, and if there's some content you'd like to see regarding selling your home, put it in the comments section. We're making video all the time. Again, Mark Stillings, and I'd like to get your home sold in San Antonio.